Welcome to the Deep Dive. We're the show that takes those, dense financial reports, all the management talk, the analyst takes, and boils it all down for you. Today, we're looking at an airline, Delta Airlines, ticker DAL. Their Q3 earnings just dropped on October 9th. But this isn't just about planes and peanuts. We're using Delta's report like a forensic tool. Because in airlines' health, especially a big one like Delta, it can tell you a surprising amount about the whole economy. So our mission today: look past the headlines, they were pretty good, right? And figure out what signal Delta's performance is really sending. Is the strong showing a sign that, consumer spending is rocketing up, a green light for the economy maybe heading into the next few quarters? Or is this mostly about Delta? Is it about smart moves they made, things that might actually be hiding some persistent weaknesses out there for the average person? Getting that distinction right is crucial, and it means we need to get granular, really dig into their strategy and the specific numbers.
Exactly. That's the core question, isn't it? And how you answer it really changes how you should think about the market right now, whether you're an investor, a business owner, or just, tracking where things are going. Now, the immediate news, like you said, it's good. No denying that. Delta looks like it's in great shape. Q3 was solid. Guidance is up. Management sounds positive. But just stopping there and saying, okay, great, economy is booming, that's probably a mistake. We've gone through a lot of material here, the SEC filings, the earnings call transcripts, analyst reports from different sectors, just to really understand not just what happened, but how it happened. Our goal is basically to give you the shortcut, help you see clearly what's just Delta being Delta executing well, and what might be, a genuine signal about the broader economy. If you just take Delta's success and spread it across the whole market without thinking, well, you couldn't end up making some bad assumptions about consumer health, maybe put money in the wrong places.
Okay, let's unpack that idea of airlines as a barometer. Why do people watch these reports so closely? What makes ticket sales such a sort of leading indicator?
It really boils down to two things: the booking cycle time and how essential, or rather non-essential, travel often is. Think about other industries, right? Like manufacturing or building materials. They work on long timelines, order backlogs, slow inventory turns. It can take months for a shift in actual demand to show up in their numbers. Airlines are totally different. The booking window is super short. When consumers or businesses feel good about their finances, feel confident about the next few months, what do? They book that trip now, but flip that around. If there's economic uncertainty, if household budgets get tight, what's one of the first things to get cut or scaled back? Travel. That vacation gets delayed. The business trip becomes a video call. Maybe you fly coach instead of business. So the airline earnings, and especially what management says about current booking trends and what they expect next, it's almost like a real-time EKG for discretionary spending, both consumer and corporate. You see a sudden jump in companies booking international first class. That's a pretty strong signal they expect good times ahead. Families suddenly stop booking spring break trips 6 months out. That tells you something important about consumer caution right now.
And going into this specific report, Delta's Q3, that EKG it looked pretty weak, didn't it? There was a lot of anxiety floating around. People were worried Delta would hit a wall, especially in the main cabin, the regular seats. What were those specific worries investors had before the numbers came out?
Yeah, there were definitely some dark clouds. I'd say three main ones. Two were kind of macro, big picture things, and one was really focused on the mass market travel segment. First off, you still had the whole global trade tension thing hanging around. Remember earlier in the year, those tariff disputes? Our sources show that actually caused some weakness in Delta's bookings back then, particularly affecting their big global corporate clients, the ones who need stable international trade. Those tensions hadn't really gone away by Q3, so there was a worry that global business travel and also maybe their cargo business, which is pretty significant, might take a hit.
Okay, so global corporate slowdown fears. But you mentioned domestic worries too, right? About the average flyer.
Exactly. That was the second big concern. The state of the U.S. domestic travel market, particularly at the budget end. The really big flashing red light was back in August when Spirit Airlines filed for Chapter 11 bankruptcy. That's a huge deal. When a major low-cost carrier, someone built on volume, goes under, it suggests there are some serious problems, maybe with demand at the lower price points. Are people just cutting back on flying altogether? Or maybe even the lowest fares are becoming too much for a lot of households. It signals fragility. And that fed directly into the third worry: specific concerns about Delta's own main cabin. Look, Delta pitches itself as premium, absolutely. But the main cabin, economy class, that's still where most of the passengers sit. It's the volume driver. So the thinking was, if the average Joe, the non-business flyer, is feeling squeezed, Delta's got to feel that pressure in its main cab numbers. That seemed almost unavoidable.
So the stage was set for potential disappointment, industry problems, budget airline failures, macro worries. It didn't look great. But then the Q3 numbers actually hit, and pretty quickly, didn't they? Those fears just seemed to evaporate based on the results and what management said. It was a total reversal of the mood.
Oh, absolutely. It felt like a huge sigh of relief across the market, I think. Because Delta didn't just, hold steady. They actually did really well. The numbers showed this company, Delta specifically, was somehow managing to fly above the turbulence affecting the rest of the industry. And that's why we need to pull these numbers apart now. Was it just Delta being smart, or is the whole economy healthier than we thought?
Right, let's get into those numbers then, because this wasn't just meeting expectations, was it? It was beating them, showing their own earlier predictions were maybe a bit too cautious. Let's break down the key metrics that stood out.
Yeah, outperformance is definitely the word. You can see it clearly across the main financial metrics. Let's start with revenue. They reported non-GAAP year-over-year revenue growth of 4.1%. Now, okay, 4.1% might not sound earth-shattering on its own.
But context is key, right?
Exactly. The context is their own guidance. Management had guided for somewhere between 0% and 4% growth, so hitting 4.1% means they landed above the high end of their own forecast range. In this kind of uncertain environment, that signals real strength. They have pricing power, demand is holding up better than they even expected.
Okay, top line beat. But for airlines, profitability, that operating margin, is always a huge focus for investors. How do they do there?
That's where things looked even better, actually. The non-GAAP operating margin came in at 11.2%. Their guidance range for that was 9% to 11%. So they didn't just beat it. They beat the top end by 0.2 percentage points and the bottom end by over 2 full points.
That seems like a big deal for an airline.
It is. Airlines are capital-intensive, high fixed-cost businesses. Small changes in margin have a big impact. Beating the range like that suggests they're managing costs incredibly well, maybe fuel, maybe labor, and they're not having to discount heavily to fill seats. They're running efficiently and keeping more of every dollar they bring in.
And the final piece, the bottom line everyone watches. Earnings per share, EPS.
Right. The non-GAAP EPS landed at $1.71. Their guidance was $1.25 to $1.75.
So right near the very top end.
Pretty much bang on the top end. So you put it all together. Revenue beat, significant margin beat, EPS at the high end. The message coming out of these core numbers is pretty clear. Delta's business model isn't just weathering the storm, it's actually performing exceptionally well, thanks to how they're running things.
Okay, now let's talk about that segment that had everyone worried beforehand, the main cabin. We know the actual revenue number there was still down 4% compared to last year, but management didn't sound worried. They sounded positive, talking about this main cabin inflection that was President Glenn Hohenstein's phrase. What did he mean by that? What's the inflection?
Yeah, that phrasing is really important. It shifts the focus from we're still down to we've turned a corner. Even though the final Q3 number showed main cabin revenue down 4% year over year, Hohenstein was pointing out that the trend within the quarter improved faster than they thought. The inflection point where things stopped getting worse and started getting better, or at least stabilizing, happened earlier than they projected. And CEO Ed Bastian backed that up, just saying plainly, main cabin trends are improving.
But if the number was still negative, down 4%, why the optimism? Did they explain why things inflected earlier? The source material mentioned a specific reason.
They did, and it's absolutely critical for understanding the bigger picture. Hohenstein pinned it down to two things happening together. Industry supply moderated and demand improved.
Okay, break that down. Demand improved sounds good, but industry supply moderated.
Right. Demand improved is straightforward. More people wanted to fly or were willing to pay a bit more. But industry supply moderated means there were fewer seats available overall across all airlines. So the improvement Delta saw wasn't just because of a massive surge in demand. It was a combination of some demand improvement, plus the fact that airlines generally weren't flooding the market with seats. When supply is tighter, even a modest uptick in demand can lead to better fares and fuller planes.
That supply point. We definitely need to come back to that when we talk about what this means for the whole economy. It sounds like a key piece of the puzzle. But sticking with management's confidence for a moment, Hohenstein apparently got even more specific about recent trends. He gave a timeline.
He did. And this detail likely gave the market a lot of confidence. He said, and I'm quoting roughly here, over the past 6 weeks, sales trends have accelerated across all geographies and in every advanced purchase window.
Wow. Okay. Past 6 weeks, accelerated, all geographies, every window. That sounds very specific and very positive.
It really does. Accelerated means things aren't just improving, they're improving faster. All geographies suggest it's not just a U.S. story. Every advanced purchase window implies both last-minute bookings and people planning trips further out are getting stronger. When management sees that kind of broad-based acceleration happening recently, that's when they feel comfortable enough to raise their forecast for the whole year, and that's the strongest signal they can send.
Let's talk about that updated forecast then. Based on this Q3 strength and those recent trends, how much did they raise the bar for the full year?
The changes were significant, showing real confidence. For the full year, they now expect EPS to be approximately $6. Their previous range was $5.25 to $6.25.
Okay, so $6 is technically inside the old range.
It is, but narrowing it down from a dollar range, $5.25, $6.25, to a single target, $6 approx, right at the upper end. That signals they see much less risk now. They're basically saying we're highly confident we can hit that top tier.
And what about cash flow? That's always crucial, especially for a company investing heavily like Delta, free cash flow, FCF.
Also a strong upward revision. Their previous guidance for full-year free cash flow was $3 billion to $4 billion. They updated that to $3.5 billion to $4 billion.
So they raised the floor by $500 million.
Precisely. Lifting the bottom end of the FCF range by $500 million is a massive statement. It says they're not just profitable on paper, they are generating a lot more actual cash after all their spending than they previously thought they would. And that extra cash generation is vital because, as we're about to discuss, their whole strategy depends on spending billions on upgrading their fleet. That stronger FCF directly fuels their ability to keep doing that. So yeah, the picture from part 2 is just. Delta is firing on all cylinders. Great execution, efficient operations, delivering strong financial results.
Okay, so we know they make good money. Now let's look at where that money really came from. Because the story shifts dramatically here, right? Away from that slightly improving main cabin and squarely onto the premium seats. And this wasn't just a lucky quarter. This is their plan. This is the core Delta strategy we've heard about for years. Make the fancy seats drive the growth.
Absolutely. This is the strategy. It's the reason people invest in Delta stock, frankly.
Yeah.
The whole thesis is built on premium revenue consistently growing faster, much faster than main cabin revenue. And Q3, it was like a textbook example of that strategy working perfectly. Consider this. Premium product ticket revenue, that's things like Delta One, First Class, Premium Select, it jumped 9% year over year.
9%. Okay, compare that to the overall revenue growth we talked about earlier.
Which was 4.1%. So you see the difference immediately. The premium segment grew more than twice as fast as the company overall. It's pulling the average up significantly. It really is the engine. Just in Q3 alone, those premium products brought in $5.8 billion in ticket revenue.
$5.8 billion from just the front of the plane, essentially.
It's a staggering number. It shows this isn't just a nice little bonus category. It's where the real money is being made. It dominates their profitability picture, which is why management is laser-focused on maximizing it.
And the logic behind that focus is pretty simple economics, isn't it? President Hohenstein basically spelled it out.
He did. He laid it out very clearly. Something along the lines of the best margins are in the most premium products, and you just work your way down. Think about it. A lie-flat seat on an international flight, the price is high, the customers are often less price-sensitive, especially corporate, and the supply is very limited. The profit margin on that seat is just vastly better than a seat in the back. Delta's genius has been engineering their whole operation, the planes, the service, the loyalty program, to capture as many of those high-margin travelers as possible.
So who are these travelers spending 9% more? It sounds like the big story here is the return of the business traveler. That segment that was hit so hard during the pandemic seems to finally be back in force.
That's arguably the single biggest driver of this premium surge. CEO Ed Bastian specifically pointed to it. He said the strong performance since the summer was, and I quote, led by a rebound in business travel, end quote. And he put a number on it. Business travel was up high single digits in the quarter.
High single digits? That's pretty robust.
It really is, especially for that segment. We're talking about corporate accounts, people traveling for work, often booking closer to departure, often in those premium cabins. Seeing that segment rebound so strongly confirms that companies are opening their wallets again for travel. They see it as necessary for deals, for client relationships, for managing global teams. It's not just an optional cost anymore. And crucially for Delta, these are the customers who reliably fill those high-yield seats, the ones that generate those fantastic margins we just talked about. Their return directly translates to Delta's bottom line beat.
Okay, so the strategy is working, the target customer is back. But how are they actually making this shift happen on the planes themselves? It's not just marketing, right? They have to physically change things, and that costs money. Yeah.
Exactly right. This is where that strong free cash flow becomes so important because the premiumization strategy requires serious, ongoing capital investment. Hohenstein actually detailed the two main ways they're physically increasing the number of premium seats on their planes. The first way is through aircraft retrofits. This is a big undertaking. They're taking existing planes already in their fleet that maybe had a more traditional economy-heavy layout.
And ripping out seats.
Potentially, yes.
Mhm.
Reconfiguring the cabins. Pulling out rows of main cabin seats to make space for more first-class pods or more premium select seats. It's a complex modification process.
So they're actively reducing the number of cheaper seats to make room for more expensive ones on the planes they already own. How much of the new premium seating comes from this?
He gave a specific range. These retrofits account for about 25% to 30% of the incremental premium seats they're adding across the fleet. It's a significant chunk, and it shows a real commitment. They're spending that cash flow we talked about to fundamentally change the layout, the seat map of their existing assets to chase those higher margins. Then the second way is maybe more straightforward. New aircraft deliveries. This is about the future fleet. Every new plane Delta takes delivery of from Boeing or Airbus is arriving configured differently than maybe they would have ordered 10 years ago. They're coming off the assembly line with a much higher proportion of premium seats already built in. So as they modernize the fleet, the overall premium mix just naturally increases.
Okay, so it's a two-pronged approach. Fix the old planes, order the new ones right. It paints a picture of a very deliberate, very physical shift towards the front of the plane. If you put all of part 3 together, Delta's success looks like a direct result of this multi-year plan working exactly as intended. Capture the high spenders, control the premium supply, invest heavily to make it happen. It makes the case for Delta, the company, and the stock look incredibly strong. But, and this is the pivot point for our whole deep dive, we can't just stop there. That's too easy. If the success is really driven by these specific targeted actions, changing seat maps, benefiting from a specific corporate travel surge, then we have to seriously question whether it tells us anything positive about the average person's spending power or the economy overall. We need to challenge that extrapolation.
This is really the heart of it, isn't it? Getting this nuance right. Because you see that $1.71 EPS, you hear about 9% premium growth, and it's so tempting to just say, wow, consumers are back, businesses are booming, everything's great. But when you dig into the how and the where within Delta's own report, the source material strongly suggests that conclusion is, well, shaky at best. It looks more like Delta is navigating around broader weakness, not necessarily benefiting from universal strength.
Okay, let's tackle the first big counter-argument. You mentioned it earlier when we discussed the main cabin inflection. Hohenstein himself said it was partly because industry supply moderated.
Yep.
Argument 1. This is about capacity discipline, not just pure demand surge. What does the reliance on moderated supply tell us about real consumer strength in that main cabin?
It tells us that while demand might be getting a bit better, the improved results in the main cabin are getting a significant boost from something else: scarcity. Delta itself is being disciplined. As we discussed, they are actively removing main cabin seats during retrofits. They're being careful about adding too much capacity on routes. That's their own strategic choice. But it's not just Delta. The entire industry is showing more capacity discipline than maybe it has in past cycles. And a big reason for that brings us back to the budget carriers.
Like Spirit Airlines filing for bankruptcy.
Exactly. Spirit and other budget airlines facing financial pressure simply cannot flood the market with ultra-cheap seats the way they used to. They don't have the financial strength to keep expanding aggressively or even maintain their previous schedules. They're cutting routes, parking planes.
So less competition at the low end actually helps Delta.
It helps all the established carriers, including Delta, maintain better pricing power, even in the main cabin. That industry supply moderated phrase is key. If there are fewer cheap seats available overall, it puts a floor under pricing. Delta can achieve better results in its main cabin, that earlier inflection, without needing some massive organic wave of consumers suddenly feeling flush with cash. A portion of that main cabin improvement is directly linked to this tighter supply environment, created both by Delta's choices and the struggles of its competitors.
That's a really critical point. So the main cabin stabilization isn't a pure reflection of the average consumer's wallet getting fatter. It's partly an outcome of supply being deliberately constrained across the board. Okay, let's move to the second major piece of evidence that challenges the everything is awesome narrative: the specific geographic weaknesses that showed up in Delta's international results. If the global consumer and business climate were truly roaring back, you'd expect strength everywhere, wouldn't you? Especially on those profitable international routes.
You absolutely would. You'd expect those segments to be booming alongside the premium domestic and business travel. But that's not what the filing showed. Instead, we saw clear pockets of weakness, particularly in mass-market international travel, which directly contradicts the idea of a broad-based, healthy consumer. Let's look at the specifics mentioned in the source material. First, Atlantic revenue. That's flights to Europe, primarily. It was actually down 2% in the quarter.
Down, even with premium doing well.
Down 2%. And management was specific. The weakness was concentrated in the main cabin on those transatlantic routes. Think about who flies main cabin to Europe. Yes, some business, but a lot of leisure travelers. It's a big, often expensive, discretionary trip for many families or individuals. Seeing that segment decline, even slightly, suggests that the average person is perhaps thinking twice about that big international vacation, still hesitant or maybe unable to swing it.
Okay, so weakness across the Atlantic in the main cabin. Any other areas?
Yes. Latin America revenue was also down by 3%. And again, the commentary was specific. It was primarily due to softness in demand for Mexico leisure markets.
Mexico, that's usually a pretty popular, accessible vacation spot.
Exactly. It's not like some exotic, ultra-expensive destination. It's a core leisure market. When you see demand softening for places like Cancun or Cabo, that's often a pretty reliable indicator that the average household is feeling the pinch on their discretionary spending. Those beach vacations are getting postponed or canceled. So these specific international weak spots, particularly in the main cabin leisure segments, they paint a very different picture than the headline numbers might suggest. It looks like the affluent traveler, the business traveler, they're back. They're driving that 9% premium growth. They're less affected by inflation or interest rates, perhaps. But the data from the Atlantic and Latin America main cabins suggests the broader base of consumers, the mass market, is still under pressure. Delta's overall success is masking that underlying softness because they've deliberately tilted their business away from relying solely on that average consumer.
Okay, let's try to bring these counter-arguments together then. We have Delta performing brilliantly, hitting numbers, raising guidance. But that success seems heavily reliant on a premium strategy, capturing high-end corporate travelers, and crucially benefiting from industry-wide capacity constraints that help prop up main cabin results. And at the same time, we see specific evidence in their own numbers showing that mass-market international leisure demand is actually soft. So what's the final synthesis here? What does this tell us about the real state of the fundamental consumer, the one who drives most of the economy?
I think the synthesis points strongly towards a bifurcated picture. The economy isn't uniformly strong or uniformly weak. It's split. Delta's results are a masterclass in corporate strategy. They identified the resilient, high-spending segment. They invested heavily to capture it. They manage capacity ruthlessly, and they execute flawlessly. That's why the company, DAL, is doing so well. It's a testament to their management and plan. But it is not, based on this evidence, a reliable signal that the average consumer is thriving. The geographic weakness in leisure, the reliance on moderate supply for main cabin stability, these strongly suggest the mass market is still facing significant headwinds. So, mistaking Delta's specific strategic success for a sign of broad-based economic health. That would be reading the tea leaves incorrectly based on everything we've dug into here. Hashtag outtag outro.
Okay, that really clarifies things. It feels like we've uncovered two distinct narratives running side by side throughout this deep dive. Story number one. Delta Airlines, the company, is executing brilliantly. The premium strategy is working. Business travel is back supporting it. Capacity is managed well. It's a compelling bull case for DAL stock itself.
Absolutely. That story is clear and well supported by the Q3 results and the updated guidance. They are navigating the current environment exceptionally well from a corporate perspective. But story number two, the one about the broader economy and the average consumer, is much more cautious. The reliance on supply constraints for main cabin improvement, the softness in international leisure, it sends a much weaker signal about mass market discretionary spending power.
So for you listening right now, if we boil down everything we've pulled from these reports, the filings, the commentary, the analysis, what's the single most important actionable takeaway?
It's sharp, I think. View Delta's success primarily as evidence of a superb company strategy working in its intended high-end niche. The results absolutely support a positive view on Delta Airlines stock based on their execution. However, do not take that success and automatically assume the third quarter was great for all consumer spending, especially at the mass market level. The specific evidence within Delta's own report argues against that extrapolation. The strength is specific, driven by premiumization and corporate recovery, not necessarily by a tide lifting all boats. Understanding that difference is key to assessing other parts of the market accurately.
A really vital distinction to make. Thanks for clarifying that so well. And as we wrap up this deep dive, we always like to leave you with a final thought, something to chew on as you watch other companies report and think about the economy going forward.
Yeah, building on everything we've discussed, if the path to success and stability for a major airline like Delta seems to increasingly involve aggressive premiumization, focusing relentlessly on the wealthiest travelers, and relying on industry-wide capacity constraints, meaning fewer affordable options for everyone else, what does that ultimately tell us about the underlying health and resilience of that average consumer, the one who isn't flying Delta One? Is this premium-focused, supply-constrained model we're seeing just a smart corporate strategy, or is it perhaps a sign of a widening gap, reflecting underlying fragility in the broad base of the market that drives most economic activity? Keep that question in your back pocket.
Watch how dependent other companies seem to be on just their highest-end customers. It might tell you a lot about the real strength or lack thereof in the wider economy over the next few quarters.
A provocative thought indeed. Until next time, keep digging deep.